John, if I can start with you. We heard a lot, obviously, in the presentation and a lot in the report around the different areas of risk. If we're looking across different industries, even subsectors within financial services, insurance, obviously, as Jonathan said, that risk is good in many ways for insurance. It is a part of the model, but obviously insurance, the insurance sector has a lot of questions in terms of risk and sustainability moving forward with all the climate challenges that we face. It would be very good to hear from you just how at your company you've looked at that challenge, what you're doing differently, and especially that, have you adopted that very different approach, the much more forward-looking calculation rather than sort of traditional actuarial based on numbers of events in the past, given that we're moving into a rapidly changing environment?
Oh, thank you. Great report, and how interesting. RCP 8.5, what does that mean? It's a residual concentration pathway. It's a scenario that says how much carbon dioxide will be in the atmosphere. And what does 8.5 mean? Does it mean 8.5 degrees? No, it doesn't. It's a measure of watts per meters squared. It's a measure of something called radiative forcing, which is the difference between the amount of energy coming in from the sun versus the amount of energy that's reflected away. And obviously, if you absorb more energy, it gets warmer. And roughly, 8.5, RCP 8.5 is roughly equivalent to a 5-degree warming world. Just to put that into context, the Paris Agreement goal is to get substantially below 2 degrees, really 1.5 degrees. That's roughly RCP 2.6. So the effects which McKinsey have illustrated in this report of RCP 8.5 are really the very, very worst effects. And it's good because it really focuses the mind, coming back to this point about risk. Because human beings, strangely, we're very bad at understanding risk, especially likelihood. I mean, think about it. You've seen the signs in most places for lotteries. You might even play the lottery yourself. You might have been to a casino. And of course, they always tell you, don't they, every week there's a winner. What's the chance of winning every week? It's about, in the UK lottery, it's roughly about 1 in 45 million. You're much, much more likely to get hit by lightning. Definitely more likely to be run over and killed or die in a car or have a heart attack. So it's kind of in the risk world, people who are expert in risk, whether you're running a casino or a lottery, or even if you're in the finance sector and you're trying to understand where to allocate capital, we have to somehow overcome the fear and panic that comes with this misperception and misunderstanding, especially of likelihood. But I can say right up front that the way the world is going at the moment with where we've allocated capital and what we're doing around the world, whether it's in all the energy-intensive sectors which provide the vital services that drive all economies, whether it's energy, mobility, and I don't just mean personal mobility in your own plane flights, those of you who are feeling guilty about your frequent flyer status, but it's also about supply chain and how do we move goods around the world. And then how about all those hard to decarbonise industries that are fundamental for producing products for infrastructure, iron and steel, glass, cement, and then petrochemicals. You're probably wearing or holding something on you, maybe your mobile phone or possibly your watch strap or your belt or your sole of your shoes, which is plastic. And fantastic, that's really good. You probably quite like the benefits it brings to your life. But we don't want to lose those, but we have to do that in a lower carbon way. And then finally, what about agriculture and agriculture more broadly? How do we feed nearly 8 billion people on the planet in a low carbon way? What about regenerative farming techniques, moving away from an oil-based agricultural system? These are all the things, practical things, that as financiers, as insurers, we have to think about how that's going to change and how that changes the underlying risk. And to answer your question, have we thought about that? Absolutely. And of course, since the Paris Agreement, the G20 finance ministers got together and moved and through the Financial Stability Board, recognising the systemic nature of this climate risk, asked the FSB to create a framework to understand this. And of course, we now have the task force, there was the task force for climate-related financial disclosures still ongoing, which has created a framework for us to think through how does the future look. And it's essentially around scenarios and then using those scenarios to think through how does that affect every part of our business model. And for insurers, that's not just the physical risks that we insure or some of the liability risks we insure, but of course the assets side of our balance sheet, which we, as the business model of insurance, people sometimes forget this. You give an insurer a premium, and we look after that premium for a very long time sometimes, maybe 30 years, before we give it back to you as a claim. And so what does that mean? It means insurers are kind of a very important bulwark of stability in the financial system, because we're the natural purchasers of financial assets like corporate and sovereign bonds that may have a very long tenor, and we typically hold them to maturity. So we naturally have a long-term view, and I love the comment earlier on about grandchildren. If you have grandchildren, chances are they'll be alive by the end of the century, when the worst effects of climate change will be coming true. And so that really focuses the mind again about likelihood and risk perception. We have to do something now to address these issues. And I think this decade really is the decade of resilience, of both adaptation to the consequences of climate change and then mitigation of the greenhouse gas emissions that are driving it.
Thank you. Rhian-Mari, Green Finance Institute has been around for
8 months.
8 months now. Started as an initiative, I think, out of the City of London, or connected to initiatives from the City of London. So it's clearly dealing with finance and a lot of the businesses around this part of the world. We have a number of different, we heard about the Task Force of Climate-Related Financial Disclosures. We have a number of initiatives to bring green finance, sustainable finance into a sort of a global framework. We have the politics, we have businesses. A lot of those are running parallel. Some of them are working well together. Others have diverged, and there's been a lot of development over time. It'd be great to hear from you in terms of what you're hearing from the different sectors, the different institutions in financial services world, where that consensus is coming together and where we're likely to see a sort of some results in those areas.
Thanks ever so much, and thank you for inviting me to come and speak this morning. Congratulations to McKinsey on not only a fantastic report, but the timeliness of your report. The focus on resilience and adaptation, it's always been a little bit of a neglected orphan in the discussion about climate, and now is absolutely the right time for us to be really discussing that. And it was a point I think Robert made, which was what are we waiting for? This is happening now, and it really is happening now. Data out of the Met Office just this week about February being the wettest month on record. I'm sure that made the headlines. What possibly didn't make the headlines, and which I found even more shocking, is the 154.9 millimetres of rain that fell last month. It was 258% of the average for a typical February. And the Met Office, when they produce their maps, they have a colour scale, and they've only ever had to go up to 200% before. And so they've had to come up with a new colour. Not only to go over 200%, but to go up to 400%. This is really happening now, and to bring in the finance context of that, I want to share a story with you, and I will get onto your good question in a second.
Please, go.
But I did want to share a story with you, which is prior to the 2008 crash, a gentleman called David Burt in a company called Cornwall Capital in the States made an awful lot of money shorting the subprime crisis, so basically betting that prices were going down. And he has quit his job again. I wanted to actually mention a very important point. His company featured in that film, the Michael Lewis, The Big Short, and Brad Pitt actually played one of his colleagues. So as far as I'm concerned, his credentials are done, right? So he's quit his job again, and he has set up an investment vehicle that is starting to look at opportunities of shorting the RMBS market, so the residential mortgage-backed security market, in climate hotspots like Florida, which you mentioned earlier, Jonathan, and Texas. His thesis is that the flood maps in the states at a federal level are so outdated that actually flood risk is so mispriced in real estate that when those maps are updated, which they'll need to be, the impacts that that will have both on insurance and on house prices will have an impact that will far, far outweigh the correction that we saw pre-2008. And the reason I make this point is in his prospectus to clients, he doesn't talk about a 10 or 20-year time frame. He talks about a market correction in the next 2 years, which is, when you think about it, and that's what I want the conversation to be. I get the point about grandchildren, but in that ridiculous way of name-dropping, the person that writes Prince Charles's speeches on climate, which have been incredibly powerful over the years, has taken out of his speeches any reference to we are doing this for our children or our grandchildren. Because the point is we are doing it for now, as anyone whose house is currently flooded in the north of England or back home in Wales would attest. Sorry, long story.
Thank you.
But the point I actually wanted to make, which is a very good one that you made there, Charlie, was the point about the TCFD, and I'm an emeritus member of TCFD, having sat on it a few years ago in my former role at Barclays. And clearly it is doing a fantastic job at raising global dialogue around disclosure. So for anyone who's not familiar with it, there are 1,000 companies around the world, including all the systemically important banks, have signed up to a new framework, voluntary framework, for disclosing how climate impacts the business. And I think we've got to a really interesting point in the whole green finance space where greening finance, things like disclosures and reporting and looking at financial stability, recognizing it's the largest single systemic risk to the financial services. That debate is going on. But to the point about the imminence and the urgency, we need to talk about financing green. Actually, how do we get the coalitions of people, the sovereign wealth funds, the banks, the institutional investors who have money, who are willing to actually start putting it to work? I'm sure Daniel will talk about all the fantastic initiatives they have ongoing at HSBC, and hats off to you for all the work that you are doing. But in the last couple of years, there's been just over $560 billion on average of private capital that has been put towards the climate emergency. It is wholly inadequate. And we need to find ways, and this is why the Green Finance Institute has been set up. We're seeded by government, but we're led by bankers. So we're sitting at that interface between policymakers and the city. And we're trying to find ways of coming up with new finance mechanisms and new financial facilities that do blend public balance sheet with private capital, to crowd in private capital, to actually get money moving towards the things that we need to finance today. And I'll be honest, our focus to date has been more on the mitigation side. How do we retrofit homes? And how do we look at deforestation in our supply chains? But we also are looking at resilient infrastructure. And the point that today, because of the work that is very clearly set out in the McKinsey report, infrastructure pricing is clearly mispriced. We are not taking into account physical risk, and therefore we need not only to change, adapt climate forecasting into socio-economic trends, we actually need to turn them into cash flow forecasts that the bankers and the institutional investors can use when they are making decisions. And that is one of the programs that we are working on with Willis Towers Watson and a number of others to look at how do we start creating those maps in a coalition of climate resilient infrastructure.
Thank you. Daniel, you're representing one of the globally significant banks, a systemic bank in the international system. We've heard about the various sort of models and the interface between private sector and policy. Obviously, HSBC straddles the developed and the developing world, and a lot of very interesting jurisdictions which have their own issues around development and infrastructure. It would be great just to hear from you how HSBC is working with within the financial services industry, your own kind of projections and policies in terms of how you're looking at what you finance and the financial structures, but also kind of where that aligns with policy more broadly, and any sense of optimism or not from your perspective and how that is working would be very interesting.
Yeah, let me start with you. Thank you very much. Let me start with the last point, a sense of optimism. And And by the way, John, I love that the insurance industry, you start with the statistics, which is a fantastic representation. In my mind, we are quite far away from moving what I would call a tactical change agenda to a system change agenda. And Jonathan, I think you were more optimistic about the ability of capital markets to price risk rapidly. I don't quite agree with that observation at the moment. And what do I mean with this? And I'm saying this to be a bit contrarian, to have a good debate, right? So what do I mean with this? I think at the moment we are trying to address the climate change agenda with a number of measures that are moving the dial. Like we have created every form of coalition that there is in the world. There is the network of central bankers and the network of finance ministers, and I'm chairing a number of banking networks, and I think we have a fantastic dialogue with the Green Finance Institute. We came to this out of the Green Finance Task Force of the UK government. So I think there's great momentum. There is quite good attention to this topic now in the public markets, in particular in Europe. There is, I think, a good momentum in the obvious sort of green product innovations. The green bond market has grown 58% globally over the last 3 years annually, which is a great success. The number of ESG asset management products is growing double-digit every year, which is, I think, a great success. And to your point, Rhian-Mari, disclosure has moved a long way, right? We created TCFD 3 years ago. Now 1,000 companies report. But if we're really honest with one another, at the moment we only get to the very obvious topics where we see risk. So obviously people are concerned about flood risk in Florida and starting to price this. Obviously people are now concerned about coal and whether a new coal-fired power plant is still viable because it has to run for 50 years. But I think we struggle to get to the next level. And what do I mean with the next level? I have four things that I wanted to pull out. One, getting into these transition sectors. John, you mentioned a few of them. Coal is a very easy discussion because there is an agreement that I think in the world largely building a new coal-fired power plant today is actually environmentally no longer sensible, but also financially probably no longer sensible. But what about steel, cement? What about shipping, aviation? We struggle to find a framework how to think about transition and how to make financial flows actually adequate, because at the moment we can't really price the risk of investing into a shipping company, because we know shipping will be around, but there will be maybe a carbon price, but if the carbon price doesn't come on time. So I think finding ways to get into the sectors that are sitting in the middle, and I always quote the statistics, 70% of global greenhouse gas emissions are down to 100 companies in the world. These are the 100 companies that are currently still dominating the global capital markets. Those are the companies that will need to transition, but at the moment we don't have a good way of getting to them. Second topic where I think we're falling short at the moment actually is going global and going into the private capital market. So I think we sit here in London and I think we believe that there's real momentum, but it's happening in the public markets and it happens in Europe. When you go to Asia, when you go to the US, and once you leave the Fortune 500, the picture is very, very different. So if you look at coal-fired power, coal mining, there is a huge amount of private equity chasing these assets because people are looking at the cash flow profile and say, this is a fantastic investment. Why would I back away from it? If you're a publicly listed company, you will struggle, but private equity is still going there. Disclosure, and I think you're doing great work there, and Mark Carney is obviously on this topic. We have great disclosure now, but it's so inconsistent it doesn't give any pricing signals. And we all believe that actually financial markets are really efficient if you feed it with good information. At the moment, we just feed it with information, but the information is completely inconsistent. I think our TCFD disclosure is really good, but our TCFD disclosure looks completely different from the one that Citi puts in the public domain. So if you can't compare the probably most comparable banks in the world, Citi and HSBC, it's very hard to say actually, we think these guys are more exposed or less. And my last topic is I think the biggest element, and I think we're making great progress there, is integrating climate risk into the risk management frameworks of banks. And that's where I think the Bank of England has put forward great proposals on a stress test, on a regulatory framework how to do it, but we're just getting started with that work. And I think the stress test is a phenomenal tool because it will expose over a 30-year forward-looking framework how a financial institution will perform in 3 different scenarios. One is one where you have rapid transition away from carbon-intensive industries, so you have massive transition risk. One is how we are performing if we're essentially just executing Paris, which is BAU, we're sort of making progress but not enough. And one is where you have rapid acceleration of climate change and you get more and more physical events. And I think that is going to be a fantastic framework because once you do this, you actually get to price it, because central banks will do what their central banks do, right? They will say, you will hold to have more capital if you're performing in a certain way. But at the moment we have a pilot in the UK which will run next year, we have a pilot in France, and we have a pilot in Singapore. That's quite far away from making this a system change that happens around the world. So I'm a little bit more on the pessimistic side, how to move from great momentum to system change. And we all know that if we want to allocate capital rapidly, we need more than, at the moment, I think, ambitious leaders changing the agenda to actually a framework that really solves for the wider good. Maybe I'll pause here.
Thank you. No, that's great.
Can I just come back on a couple of those points? As always, Daniel makes a number of excellent points. The point about the pricing signals and the disclosure actually being decision useful so that you see that reallocation of capital, it is going to be dependent on having these forward-looking scenarios and stress. Exactly the point that you were making, Jonathan, that financial services traditionally rely on backward-looking models and extrapolation. And we need to have a bold and courageous new way of looking at risk and being comfortable of looking forwards rather than backwards. And so the work that the Bank of England is doing, I think, is going to be critical. And the fact that they are doing it not in isolation, one of the things that gives me hope is the Network for Greening Financial System. The fact that we've got over 50 central banks working together. Because if there is one thing that I think will really... There is a risk with coronavirus and a number of other things that we may lose some of the momentum that we've seen in the last few years, as imperfect as it has been, with whatever the very latest concern is. But I think by embedding it in the stress tests of the banks and having the central bankers, who by definition have a longer term view of financial stability, that's the area that I think actually could embed this in a way that we may not lose some of that momentum, which is really important. And just finally, the fact that there is a proliferation of all these different groups and coalitions, that is the nature of disruption. And that we are in the eye of disruption in the financial services market. And yes, it would be great if we could have some intergalactic task force for reallocating capital, and we never know, we might get there, but it's an imperfect way of operating at the moment. But I also think that's a source of some optimism, because it shows that we're disrupting.
And I know John wants to come in, but my only caution is, I think we are a little bit blinded by sitting in Europe.
I think that's true.
It is very different when you're in other parts of the world. Sorry.
Asia House can help with that, I hope. But John.
Absolutely, that's great. And all of you in the audience as well, I hope you take away all these good things and take it back to wherever you come from and help influence these changes. So I think these are really good points about pricing. And how do you build that into the system so it actually happens at a transactional level as well as at a kind of strategic level. And I think, when I think about the transition, what needs to happen, there are at least 3 levers, of which finance is only one. And you've heard how challenging it is to change what we're going to be doing in finance, not around the world. But the other levers are economic levers that get driven by essentially governments. And many governments have signed up to the Paris Agreement, but they've got to make this real. And it's great putting some legislation in saying I'm going to be net zero by 2050 as a country, but you've got to turn that into real policy. What does that really mean? What's the effective carbon price? Who's going to pay that carbon price? And those are really big challenges, and that brings me on to my second lever, which is societal change, because we can say things in finance. The carbon-intensive sectors can change their activities, and the governments can change policy. But we as citizens will feel the impact of that. We will pay more for certain things, goods or services, that we've taken for granted. Coming into a room and switching a light on, being warm, having certain types of food to eat. I think we're on the brink of some very big consumer behaviour changes, and jobs and incomes will change as well. So absolutely, it's very clear. The IEA have made this extremely clear. To achieve the Paris Agreement goals in the Sustainable Development scenario, we cannot build any more thermal coal power plants in the world. We are at capacity. In fact, we've got to start turning them down and switching them off if we're going to achieve the Paris Agreement goals. But what does that do if you're in a coal-dominated economy? And there are many of those around the world. We've just gone through as a company an exercise saying we want to purchase only renewable energy for all our facilities in the next 2 years. We want to be completely renewable energy, no thermal fossil fuel power. Well, that's pretty easy in a lot of countries, but there are some countries where it's quite frankly not very, very, very difficult. You have to more or less create the power source yourself, because the domestic grid is powered by coal. So what happens to the people working in those coal industries? And it's a little bit like what we saw with globalization. We saw many people put out of work, especially in developed economies, as their jobs moved to developing and emerging economies. And what were we left behind? We were left behind with parts of countries, whole regions in some cases, of people unemployed and out of work, not just for one generation, but for 2 or 3 generations. And the social deprivation and impoverishment that creates, not just poverty in the sense of not having money, but impoverishment in every aspect of society. And the costs of that to society are huge. So that's something we talk about in terms of the just transition. So I think the economic drivers, the societal drivers, and then the third one is technology drivers. We can't just wish the changes to happen in these carbon-intensive sectors. We have to create new technologies, and the technologists have a great role to play here. And there will be some dead ends, there were Betamax before, more successful forms of video systems before we even moved to DVDs and now streaming on the internet. And the same's got to happen for all these carbon-intensive sectors. So whilst electric vehicles for sure work extremely well for short-distance, last-mile delivery or urban environments, actually they don't work very well when you're transporting goods across an entire continent. And then how do you change shipping and what kind of fuel types are needed there? So there's a whole range of opportunities for investors, for governments to incentivise with policy, and for technologists to create new technologies to decarbonise.
Just going to add that there is another lever, as well as the ones that you have mentioned, which is the judicial and litigation as a lever. And Robert, you mentioned Heathrow. I think that, and maybe someone in the audience correct me, but I think that was the first legal ruling to show that in the world to demonstrate that the Paris Agreement is legally binding. So it was actually a huge decision that was made just recently, and as you say, it could have big repercussions.
I'm keen to bring in questions from the audience. I just want to quickly, before that, just touch on something which you mentioned, but then I think the other two speakers have talked about. You talked about infrastructure, pricing being off the mark, in simple terms. You mentioned markets being fed information. Is this, my simple question, perhaps from a simple perspective, is this something that can be solved by the market, or do we really need a much more robust regulation around infrastructure? We focus a lot on infrastructure in Asia, where the need is huge. ADB is talking about, sort of 26 trillion over however many years, if you include the climate risk, cost which you have to build in. Can this be achieved through the market mechanism in its own right, or are the 50 central banks plus all of the other regulators really going to have to come in and drive and fix that change?
Great question. Can the invisible hand develop green fingers? Right? That is effectively the question. And I think the answer is, if we had all the time in the world, absolutely yes, but we don't. And what we have is a case of market failure, where the risks, carbon externalities, are not being accurately priced by the market, and given the urgency of the situation, there's fantastically demonstrated by the McKinsey report, that is where you do need the regulators to step in, where that is their function, where there is market failure.
All right, okay. Yeah, we've got a question here. We'll start there, and if you can just, again, say your name and your affiliation, please.
Sure, so it's Martin Grant from Atkins Engineering Consultants. So picked up on the technology word that John used there. So I think we're increasingly moving to a point where we realise to mitigate the issues that are in front of us, we actually have most of the technology available to us. The huge frustration about not building things at the rate that we should. Now, it might not be perfect technology, it'll no doubt be better in 20 or 30 years' time, but actually the priority is to build things now. Now, there's exceptions to that, and a colleague here mentioned hydrogen, so we need a solution for decarbonising heat. We have technical solutions, but what we don't have is any market within which those work. So I think from an engineering perspective, yes, we can build it, but we don't have a market that allows early stage technologies to flourish. We did that with offshore wind, by the way. The first major offshore wind farm in the UK had a strike price of about £150 per megawatt hour. It's a huge number, but of course that's built, it's gone, it's forgotten, and we're now building them at a third of that price. But the UK government, due respect, put a market in place that made that work. So there's a question at the end of this. Is it down to governments to make markets that allow the technology to work, or am I being overly simplistic here?
Now, I'm keen to get through as many questions as possible. What I'd like to just maybe pick one panellist to answer each one, and we'll keep everything as brief as we can. John, do you want to, on the technology, so do you want to...
Yeah, just following on from Rhian-Mari, sorry. I think it's governments have a role to play in terms of regulation, not so much legislation. It can be legislation in some cases, creating the planning consents to allow things to happen, for example, to mandate building codes, for example. You think of risks like earthquake risks. We know how to build earthquake resilient infrastructure, but you have to have the building codes in the country to make that happen. And we know very well what a resilient country looks like to earthquake compared to a not resilient one. And so I think there is a role for government to create markets through some kind of regulation. But it also is about the economic drivers as well, the recognition of the pricing, whether it's the pricing of the risk or the pricing of externalities like carbon price.
Yeah, we had this gentleman here in the third row. Yeah, we'll try and get around everyone, so you can keep it brief.
Thank you. Phil Drew, Brunswick. Larry Fink in his letter talks about a reallocation of capital which will come sooner than we think. One of the links between the two sessions we've heard this morning has been around the need for a probabilistic, forward-looking picture of the future. The PRI have set out to answer those essay questions. When might that happen? What would it look like? How will it play out? Who will be the winners and losers within sectors as well as between them? As signatories of the PRI, I just wanted to understand what you thought of the work they've been doing on the inevitable policy response, specifically around the forecast policy scenario, and whether that's helpful in understanding how to allocate capital on a near-term basis, given some of the transition risks and opportunities that are coming down the line.
Dan, is this a model HSBC is looking at?
I'm happy to take to that. So I think the real powerful actor here will actually be the regulator. The PRI work is super helpful to inform. We have worked with a number of academic institutions, but what you really need now is a central body that says these are the three scenarios, and I would hold you all to the same standard. Mark Carney, I think, has done a great job putting that on the agenda. He has the powerful force now to actually, through the NGFS, so the Network for Greening the Financial System, and through COP, to make this a global framework, and then actually drive this through the industry. And I think the one number that I always find very helpful in this is that the UK, as a country, is responsible for less than 1% of global greenhouse gas emissions. But the City of London manages more than 15% of global greenhouse gas emissions. So if you get actually London to move, with all the international banks here, with the stock market, which has actually a very influential role in the high carbon sectors, you very quickly actually affect a critical mass to move. So if you have the Bank of England and the City of London move, Singaporean authorities that are very, very ambitious, the French that are very ambitious, Hong Kong is now coming along. So if you start to move the big financial centers, and you know I don't mention New York at the moment, the Fed, if you would have that movement, you actually affect much more capital than you would affect GDP, but the capital is so centralized. So I think that's the powerful player. If you hadn't read the stress test publication, which came a few weeks ago, it's a phenomenal read, and I think it will be a force for massive change, because once the Bank of England puts that on the table, it means every board, every executive committee, every audit committee, every disclosure committee has to get their head around it, because they have to sign it. And suddenly you have it in the very senior boardroom rather than in the emotion, like the sustainability department.
Okay, all right, yeah. A question here.
Mark Cliff from ING. I want to see if we can sort of reframe the discussion a bit, because certainly what I notice is there's a lot of discussion in the industry about downside risk, stress tests and so on. This is the typical lens that regulators adopt. But as I like to say to our chief risk officer, you should also be the chief opportunity officer as well. Mm-hmm. And some of the scenarios are frankly completely implausible. And the point here is there's a tendency to say, oh, let's see what happens if we impose a carbon tax. And a number of the central banks have explicitly assumed that the proceeds will not be used. In other words, it's a fiscal tightening. So as an economist, this is clearly not looking very good, but it's politically implausible. So I'd like to hear your thoughts about the Green New Deal. What is going to happen to the proceeds of the carbon taxes, for example, in subsidising green energy, or indeed helping the poor, which was referred to earlier on in the initial presentation. So I'd like to hear a little bit more about more plausible, balanced scenarios.
Yeah.
I'm happy to take that one very quickly. We've recently launched here in the UK the Commission on Carbon Charging, and I'm proud to be one of the commissioners on that, looking at exactly the points that you've raised, which isn't just about what level the carbon tax should be, whether it should be sectorally different, but actually importantly, redistribution. And how do we use it both on the levelling up agenda, but importantly to your other point, on the innovation agenda, the innovation and the opportunities agenda. Because when we talk about reallocating capital, you're quite right, we shouldn't forget about where we're allocating it towards. It isn't just about what we're not going to do anymore, otherwise all we're doing is managing decline. What we actually need to do is find those opportunities. And when we look at other industries that have disrupted, they disrupt, one, because you have regulatory change, but also because there are viable alternative revenue sources that either the incumbents are nimble enough to move towards or the challengers recognise and move in. And the same is true of the financial services industry. We need to find alternative P&L routes away from the brown and the grey. And that's certainly one of the things that we're working very hard at doing at the Green Finance Institute, is actually let the work that the regulators are doing on greening the financial system, looking at financial stability. We're very supportive and working in conjunction with them, and that's where we see the gap, is pulling people together to try and find new financial mechanisms and new ways for investors to actually deploy their capital at scale towards what we need to be financing.
Two very quick points. So one, completely agree, this is the biggest opportunity for the next decade, especially in Europe where we have no growth for last decade. If we want to unlock growth, it needs fundamental change of the economy, big investment. I completely agree. Second, on the scenarios, I'm reasonably relaxed about the scenarios at the moment, because I almost feel that what the exact scenario is at the moment doesn't matter. It is almost building the muscle to deal with them, because if you go to any financial institution at the moment, we don't have the data, we don't have the systems. Forcing us to build the scenarios just means you actually have to build that muscle. We started 2 years ago. It is super complex, because we've never asked our clients, actually, what's your carbon footprint in every different country in the world, and suddenly we need to do this. So we we started this 2 years ago, and we now probably have a coverage of maybe 40% of our balance sheet. That in some ways is really good, but also is far away from having a complete view. So I think the exact type of scenario will be important in 2 years from now. At the moment, it's just to get people actually focused.
I love Sarah Breeden at the Bank of England's quote on this, where she says, in the first few years, this whole exercise will look more like an English essay than a maths test. But that's where we need to get to eventually, so that we have that, you know, those pricing signals. It does need to become a mathematical exercise, but we're not there yet. Speaking
of mathematical exercises, we've got time for one more question. Now, you asked one before, Richard, so I'm going to allow someone else, if that's all right, just behind you there.
Laszlo von Hirsch, PwC. Perhaps a slightly contrarian question, but I think it's often been absent from policy debates, and it's to do with the role of business in society, and it's something that the Business Coalition or Business Roundtable touched on last summer in the States. And to what extent can we solve some of these sustainability issues without looking at things like GDP and how we measure progress in society, and also shareholder primacy in businesses?
Who wants to take that easy question? John?
I'll take that on. No, I think that's really important, and I think, like Daniel was saying, there's got to be this shift in where we invest and how we invest from the history of the last 10 years, where to manage the credit crisis, the financial crisis in 2008, and I use the word advisedly, manage. We didn't solve the problem. In fact, we're even more globally indebted now than we were at that point, so that should strike a note of fear. So fiscal policy, and you know, this is the opportunity with these new Green Deals that are being discussed in Europe and potentially in North America, depending on the outcome of the presidential election. But those are the kind of stimuli that could really, you know, change the way that capital is allocated through society and recognised. And I'd like to just sort of call out another topic here, which is when we think about adaptation, the other thing we have to think about is biodiversity and natural climate services, and what does that mean to us? And we take all these things for granted. The fact that wetland areas are fantastic for, you know, they act as sort of like sewage farms. They're really good at naturally cleaning dirty water. But we no one values that. That's not on anyone's balance sheet at the moment. Coral reefs, which are the beginnings of, or at the bottom of the food chain that supports the entire marine food chain that is very important for feeding nearly 8 billion people on the planet. We don't value coral reefs, you know, and yes, they have some kind of tourism value, but what's that value to feeding human beings? And I think there's a big move to think about how do you create some kind of structure or sustainable accounting system that recognises these on balance sheets and then enables the finance system to support that. And there are some innovative examples. For example, I think in Mexico, the coral reef off the Cancun Peninsula, there's a fund put together by some of the hoteliers actually on that coastline to protect the coral reef, because it protects the coastline and, you know, attracts tourists. But essentially, that coral reef does get damaged by hurricanes. It will get more damaged by more hurricanes. You know, if we think of, you know, the McKinsey view of how the world's going to develop climate-wise. And so what have the financial services sector done? Well, some innovative reinsurers have actually created what's called a parametric insurance product, reinsurance product, that basically, if the wind blows at a certain level, so there's a certain type of hurricane intensity, whether there's damage or not, it triggers a payout to that fund that goes to repairing the reef. So I think these sorts of things, you know, this is just another aspect of how do we reallocate capital with the recognition of the damage that climate change is going to wreak on our societies and on our planet.
But can I give you also just one really simple example how to affect it in an organization? So our most senior executives get paid on 3 metrics: a third. Return on equity, so performance. A third, our ESG score rating. And a third, employee advocacy. So we measure quarterly snapshot survey our score. And if you pay people on that metric, you actually shift the importance. Otherwise, our topics are always nice, but they always come under any other business on the board agenda. But if actually 2/3 of your comp depend on it, suddenly you put a bit more more focus on it.
Well, before we wrap up, that sort of brings me back to my question, which I had for Jonathan, which was on behavioural change. And I don't know, Jonathan, maybe just see if you had any final comment on some of the other things you've heard since we heard your presentation, and if you had any thoughts on, kind of and certainly very interested to hear how McKinsey's going to sort of take the research forward.
Well, first of all, I've learned a lot in the last 45 minutes, so thank you. And it's an excellent panel. I sense that we do stand at a fork in the road when it comes to moving from the topic as in the realm of I love the math lesson to the English lesson. I think that said, the people on the panel are experts at mathematics, and I really. I'll close with two thoughts. One is that I think this is the debate that we need to have, and these are the people that need to have the debate, and think you are having it. And we add the regulator in, but everybody in this room has an ability to influence that. So that. And I share the concerns about the obstacles that we have in terms of creating the uniform views on disclosure, the transparency, the metrics. But I honestly would be still an optimist in that context. And I also feel like this is a conversation that is a global one. We're in the Asia House, and so I really do look forward to the next panel having folks from China Development Bank, from Niti Aayog, from the Mahindras or whoever. It's just names, but I think that I think once one has that room, you will actually discover more similarities and differences. Maybe differences in language, but similarities in approach and interests. And so I think that's an opportunity, frankly, for Asia House. But that said, now we are at this turning point. So I believe that we will, have choices that we will be, as said, held accountable for going forward. And so the statements that we make today represent a transition from a status of not knowing the consequences to knowing the consequences. And with that comes the responsibility to act on them.
Sure. Okay, well listen, thank you, Jonathan, thank you. We are out of time. Thank you everyone for your contributions. I know that there were a few more questions. We do have time. Please stay around, enjoy some networking. We have some coffee and refreshments. You're all very welcome to stay as long as you like, and digest some more of this off the stage, as they say. Huge topic. This is something that Asia House is increasingly focused on, the area of sustainability in its broadest sense, and a lot of that is to do with climate risks. We look forward to hearing more from McKinsey Global Institute, and certainly we're keen to continue further discussions, as you say, Jonathan, with a wider range of actors. So if anyone is interested in the McKinsey report, there's some folks from McKinsey here I'm sure can tell you more about it. Certainly talk to my colleagues if you're interested in more discussions on this topic. But I would like to thank all of our panelists today. I'd like to thank all of you for being here, and I'd like to thank Jonathan and his colleagues at McKinsey and Company and McKinsey Global Institute for again supporting today and for the report and for working with us on this. So thank you all very much, and see you again soon.